All right, today we're going to do something really practical. We're going to tear down a company that's about to go public, and we're going to do it using only their official IPO documents. The company is called SPEB Adhesives, and their prospectus, that's going to be our playbook for this whole analysis.
But first, I want you to think about this question. Is it possible for a company to be reporting record profits while at the same time it's actually running out of cash? It sounds like a paradox, doesn't it? Well, keep that in the back of your mind, because the answer to that question is really the key to this entire story.
Okay, so let's get into it. The company we're looking at is SPEB Adhesives Limited, and their business is pretty straightforward. They make and sell industrial adhesives. Yep, this is a company literally built on glue. Now, whenever a private company like this wants to go public in an IPO, they have to release this huge document called a prospectus. And this thing has everything. All the good stuff, all the bad stuff, and all the stuff they'd probably rather you not look at too closely. For our purposes today, this document is the rulebook. It's our single source of truth.
So when you first crack open that prospectus, you're hit with the story the company wants you to see. And honestly, the numbers look fantastic. At first glance, this thing looks like an absolute slam dunk investment. First thing that jumps out is the revenue growth. That number right there, nearly 25%, is their compound annual growth rate over the last 4 years. I mean, that is some seriously impressive and consistent growth. But it gets even crazier. When you look at how profitable they are, in the last fiscal year, their return on capital employed, or ROC, was 100%. Now, to put that in plain English, for every single dollar they put into the business, they generated a dollar of profit. That kind of efficiency is, well, you just don't see that every day. It's almost unbelievable.
And for the final knockout punch, the company has zero debt, not a dime. So let's recap. You've got high growth, incredible profitability, and no debt on the books. On paper, this company looks absolutely flawless. What could possibly go wrong?
Well, remember that question I asked you at the very beginning? This is where that perfect picture starts to crack. Because when you did pass those headline numbers and look at the cash flow statement, you find a really big problem. And here it is. This is the big contradiction. On one hand, you've got their profits, which are climbing up and up year after year. But on the other hand, the actual cash coming in from running the business has suddenly gone negative. Think about that. They're making a profit on paper, but real, hard cash is actually flowing out of the business. This timeline really puts it in stark relief. Look, back in fiscal years 23 and 24, they were bringing in cash. But then, bam! In fiscal year 25 and in the most recent numbers we have, the company is actually burning cash just to keep the lights on. That's a huge reversal. And hey, don't just take my word for how serious this is. The company spells it out for you right there in the prospectus. They say that if this keeps up, it could seriously hurt their ability to operate the business and grow. That is a massive red flag coming from the company itself. So a problem with cash flow like this one makes you want to dig a lot deeper, right? It forces you into that risk factors section of the prospectus. If the cash situation is this shaky, you have to wonder, what else is hiding in that fine print? Well, the first thing you find is a major concentration risk. Almost 40% of their entire revenue comes from just 10 customers. I mean, think about that. If they lose just one or two of those big clients, it will blow a massive hole in their business overnight. And that's not the only dependency. It turns out over half of their revenue comes from just one product category, a huge chunk of their customers are all in one single geographic region, and they get almost 70% of their raw materials from just 10 suppliers. You see the pattern here. This whole business is basically balanced on a few critical points that could fail. So what are they going to do with all this money they're raising from the IPO? Well, their main plan is a big strategic move. They want to build a whole new factory to start making something called water-based adhesives, which is a totally new market for them. Okay, on the surface, that sounds like a decent growth plan, but it raises a really important question. Do they, actually have any experience making this stuff themselves? And the answer, which you'll find buried deep in the prospectus, is a flat no. Right now, they just pay another company to make it for them. So they're planning to spend millions of dollars of investor money to jump into a type of manufacturing where they have literally zero direct experience. That is a huge execution risk.
And finally, as you keep reading, you start to see a pattern of, let's call them governance issues. There's a history of late payments for employee benefits. They failed to meet mandatory social spending rules. There are a bunch of errors in their official filings. But here's the real kicker. Corporate records for a 14-year period are just gone, untraceable. All of this kind of points to some potential weaknesses in their internal discipline and controls.
Okay, so we have this company with amazing numbers on the surface, but also some pretty serious risks bubbling underneath. Which brings us to the final and really the most important question of all. What is this business actually worth?
A good way to figure that out is to compare it to its competitors who are already public. And if you look at their profitability, this return on net worth number, SPED actually looks pretty strong. But then you get to the most important valuation number, the PE ratio, which basically tells you how much investors are willing to pay for each dollar of profit. And it's blank. It's a placeholder, because the final IPO price hasn't actually been set yet.
And that brings us to the central problem here. Trying to analyze an IPO before the final price is set, well, it's kind of like trying to buy a car. You can look at the engine, check the mileage, compare all the features to other cars on the lot, but you have absolutely no way of knowing if it's a good deal until you see that final sticker price. So, we'll leave you with this thought. You've seen the shiny exterior, the incredible growth, the amazing profitability. But you've also looked under the hood and seen the risks, the cash flying out the door, the business dependencies, the governance issues. So the question isn't just, is this a good company? The real question is, at what price does it become a good investment? Knowing everything you know now, what would that price have to be for you?